So quantitative easing is a monetary policy tool that is used by central banks to stimulate the economy when traditional methods have limited impact. And what this amounts to is that a central bank buys a substantial volume of securities in order to inject money directly into the economy. And this increases liquidity, or essentially the amount of money that is readily available, and it encourages lending and investment. And this was used primarily in the 2008 financial crisis, because during this financial crisis, conventional monetary tools like adjusting interest rates proved insufficient to stabilize the economy. And in response, the Federal Reserve and many other central banks around the world embarked on a QE, or quantitative easing program, which involved purchasing these long-term securities to flood banks with capital that was readily available. And the primary aim was to decrease interest rates on loans and bonds, which makes borrowing cheaper for banks and also for businesses and individuals. This had a major impact on the banking sector, because now more funds became available and banks saw an increase in their liquidity levels, or the money that they readily had at hand. And this reduced the cost of funding and enabled them to lend more freely. And this was crucial during the economic downturn, because many banks had previously tightened lending standards due to increased risk and also a somewhat uncertain economic outlook. And by lowering interest rates and providing banks with more capital, the method of quantitative easing helped to stabilize the financial system and to restore confidence among financial institutions. So for businesses, particularly small and medium enterprises, also known as SMEs, this increased liquidity in the banking system meant better access to loans in order to sustain their growth as a business. And during the economic downturn, the ability to secure financing was absolutely crucial for business operations and for continued sustainable growth. So companies could now borrow at lower rates, and this decreased their costs significantly. Even in some cases, the interest rates were hovering just over 0%, which historically is at an all-time low. And this accessibility to credit was absolutely vital for maintaining the continuity of all the businesses and to stimulate economic activity during the crisis. And we can see here how this method of quantitative easing affected the interest rates significantly. So here we have most countries in Europe, all part of the European Union, and we can see how the interest rates really took a nosedive after the dust settled from the financial crisis. So it took a few years for the financial crisis to really materialize. It started in the United States in 2007, then fairly quickly it spread to Europe, but with a bit of a lag. And it took a few years for the consequences to materialize. And here we can see the peaks around 2011. We can see the peaks of the interest rates. And here, this is the moment when the quantitative easing method was introduced and started to do its work. Because ultimately, this caused a very sharp decrease in interest rates, even leading to these all-time lows just above 0% around 2015-2016. So obviously these low interest rates are very incentivizing for businesses, because this lowers investment costs significantly. So this opened up a whole new world of opportunities for businesses, for new startups, etc. There's a bit of an outlier here, that is Greece. That is a case of its own. Greece essentially had a lot of issues with their debt. And so there was an elaborate scheme in the European Union in order to offset this debt. But this also caused still relatively high interest rates. Here again, obviously you can still see how there was an extremely high interest rate, but even after quantitative easing, this also very sharply dropped for Greece as well. So you can see that despite these differences, the method of quantitative easing really did its work around all these European countries. But there were still some concerns and long-term effects. And there were some criticisms too. And one of the primary worries was that injecting such large amounts of money into the economy could lead to inflation, and a significant inflation rise at that, if the increase in the money supply outpaced economic growth. In other words, this wasn't really healthy for an economy to be stimulated with this degree. In essence, this was an economy of steroids. You still need to do the work, but obviously the steroids will help you do massive work in the gym. But ultimately, this is not a healthy way of growing new muscle. And basically the same metaphor applies to the economy. There were a lot of concerns that this amount of money simply wasn't healthy for the economy. And we can see it very clearly here. So after quantitative easing did its work, this is where the economy was essentially still in shock. So around 2011, 2012, all the way to 2015. This is where the economy started to pick up a little once again. And at this point in 2020, we had the COVID crisis. And ultimately, due to numerous reasons, this led to a very sharp increase in inflation. And part of this, certainly not the only reason, but a big part of this was the high volume of money that was injected into the economy in the years previous. So currently, we are seeing efforts by governments around the world and by central banks in particular to ramp down inflation, because the inflation that we have seen across the world from 2020 to 2024 is a very unhealthy pace. And in addition, there were also issues or fears about the creation of asset bubbles, because these historically low interest rates could lead investors to overvalue assets, and this could potentially lead to market distortion. In other words, there were some criticisms that we are not letting the market do its work. Of course, you needed this money supply in order to boost the economy, but once again, this large degree of money that was injected into the economy distorted the market economies, is what many economists argued. And this then became the focal question, whether this artificial suppression of interest rates that we saw in this period, whether or not it actually tackled the actual problem at hand or merely symptoms. And currently there's a lot of evidence basically stating that the system that we're in right now, and especially with all of the debt that we have accrued over the past few decades, is a very unhealthy one at that. And we need more systemic, more deep level changes to this economic system if we want sustainable growth in the future. But that is another debate. But once again, it's crucial for you to have a decent understanding of what quantitative easing is and how it might also be used to your own advantage from a business perspective.